For most people, taxes are a huge source of stress, right? They're just this bill you have to pay. But for a select few, there's something else entirely, a cost they can actually plan for and, believe it or not, control. Now, this isn't about shady loopholes, it's about understanding that there are two totally different ways to look at the tax code. One way is just reactive compliance, the other is proactive strategy. And that proactive approach is exactly what we're going to break down today. So here's our game plan. We're going to start with the foundational mindset shift. Then we'll jump into the practical advantages for business owners and investors. After that, we'll zoom out and look at things from a long-term generational perspective. And finally, we'll tie it all together with a clear, actionable goal, engineering your own financial freedom. Okay, so everything, and I mean everything, starts right here with this crucial change in how you think. It's all about seeing the tax code not as a list of rules designed to punish you, but as a roadmap of what the government wants you to do with your money. This is such a profound concept. See, experts understand that the government literally uses the tax code to encourage specific activities that it thinks are good for the economy. Things like creating jobs, providing housing, developing new energy sources, and just fueling business investment in general. So here's the big takeaway. Every single deduction, every credit, every tax-advantaged account is basically an incentive. It's the government offering you a reward for a specific economic action. Once you understand this system, you can legally lower your tax bill just by aligning what you do with your money with these government-endorsed goals. It's that simple. And this really shows you the two different paths. Most people are reactive. They earn their money all year, and then at the end, they figure out how much they owe. But the strategic approach, it's proactive. It means you're asking questions before you even make the money. Like, how will this income be taxed? Can I change its classification? Can I control when I get paid? That right there is the fundamental difference between just filing your taxes and actually planning for them. So once you've got that mindset, it naturally leads us to the first huge pillar of strategic tax planning, leveraging the unique position of being a business owner. Let's just be honest, the tax code was not built with employees as the top priority. Check this out. This one single section of the tax code creates this massive divide between the financial rules for employees and for business owners. It basically says that any costs you have to generate business income can be subtracted from that income before you calculate your taxes. So what would be a personal after-tax expense for an employee can become a powerful pre-tax deduction for a business owner. And we're not talking about small stuff here. The scope is vast. We're talking about the salaries you pay your staff, the rent for your office space, the money you spend on marketing ads, the fees for your accountant, and even certain travel and vehicle costs. These are all things you need to run your business anyway, but they also double as powerful tax deductions, which lowers the real cost of running and growing your business. Let's just take the home office deduction. You've got two options. The simplified method is, well, simple. It's $5 a square foot and it maxes out at $1,500. But the actual expense method, yeah, it takes a little more tracking, but it's often way more valuable. You figure out the percentage of your home used exclusively for business, and then you apply that percentage to your total home expenses. We're talking mortgage interest, utilities, insurance, repairs. For a lot of people, the difference isn't hundreds, it's thousands of dollars in deductions. Okay, so that's the business owner's side. Now for the second pillar, which is just as powerful, the investor. The tax code gives huge benefits to investors because, well, they provide the capital that the economy needs to build and grow. And we're gonna focus on a big one, real estate. All right, I want you to remember this number, 750. This number is like a key that unlocks one of the most powerful tax strategies out there. To qualify for what's called real estate professional status, or REPS, one spouse in a household needs to spend at least 750 hours a year in real estate activities. And this is important, that time has to be more than half of their total working time. So why would you go through all that effort? Because REPS lets you break down the wall that separates passive and active income. See, normally, any losses you have from rental properties can only offset other passive income. But with REPS, those paper losses, which are mostly from depreciation, can be used to offset your active income from a high-paying job or a successful business. This can lead to absolutely enormous tax savings. Depreciation. This is where it starts to feel a little bit like financial magic. It's what's called a paper loss. The government lets you deduct a piece of your property's value every single year to account for wear and tear, even if your property is actually going up in market value. And what's even better, you can use strategies like cost segregation studies to accelerate these deductions, creating even bigger write-offs in the first few years you own the property. And then there's this strategy. It's often called the swap until you drop strategy, and it is the absolute pinnacle of long-term tax planning in real estate. A 1031 exchange lets you sell a property and pay zero capital gains tax as long as you reinvest all the money into another property. You can do this over and over your entire life, just swapping properties and deferring taxes forever. And here's the magic trick. When you pass away, your heirs inherit the property at its current market value. And that step up in basis can permanently wipe out all those capital gains you deferred for decades. This brings us to our third critical pillar of strategic thinking. It's about shifting your timeline away from just this year's tax bill and thinking about your lifetime tax liability and really beyond that. Right, this is where we've got to expand our thinking. Advanced financial planning isn't about what you're going to owe this April. It's about where your business will be in 10, 20, or even 30 years. It's about how you're going to move wealth from one generation to the next. When you start looking through this long-term lens, your decisions become so much clearer and a lot less emotional. So what does this actually look like? Well, it means you're planning your exit strategy before you even buy an asset. It means you're using legal tools like irrevocable trusts to move assets out of your personal estate, protecting them for the next generation. It even means thinking strategically about where to incorporate your business, choosing a state like Delaware, for example, because of its favorable laws and specialized courts. Okay, so we've talked about the mindset shift, the business deductions, the investor playbook, but how does this all connect? What's the point? Well, these strategies aren't just about saving a few bucks on taxes. They're tools to build a system that achieves a very, very specific goal. And that goal is your freedom number. Now, this isn't about how much money you have saved. It's about an income stream. It's the amount of passive income you need every year to live the life you want so that working a traditional job becomes a choice, not a necessity. A really simple rule of thumb is to have 20 times your desired annual income invested. If your investments can kick off a 5% return, they can fund your lifestyle forever. And this really shows you the path. First, you have to define that number. Second, you engineer your current lifestyle to cut out the waste, optimizing the big things like your housing by maybe buying a duplex and renting out the other half. Third, you learn to use credit as a tool for leverage, not for buying stuff you don't need. And fourth, you create a system where you are constantly reinvesting your income into assets that grow and generate even more income. So I'll just leave you with this one final thought. The ultimate goal of this entire strategic blueprint, it's to get to a point where your money is working for you, not the other way around. It's about building a system where your assets are generating more than your labor ever could. So just ask yourself, is your current financial system really designed to do that?